Welcome to the Deep Dive with Farmtips Diary. Today we explore how the recent Federal Reserve rate cut affects farmers, looking at borrowing costs, refinancing opportunities, stubborn input expenses, the limits of rate relief, and strategies that can turn financial uncertainty into long-term resilience. The hidden gravity of interest rates. Every farm is tied not only to soil and weather, but also to the invisible weight of financial systems. Interest rates, set far away in city boardrooms, act like gravity on the farm economy. When they rise, borrowing feels heavier. When they fall, the burden lightens at least a little. The Federal Reserve's recent decision to cut rates may sound abstract, but its ripples touch tractors, seeds, barns, and family budgets. To understand what this means, we need to explore how money flows through farms and why lower rates are both a relief and a reminder of deeper challenges. How rate cuts reduce borrowing costs. For farmers carrying loans on land, equipment, or operating expenses, even a small drop in rates can bring tangible relief. Monthly payments shrink, refinancing options open up. Access to credit improves, making it easier to cover planting season costs or weather temporary cash shortages. Think of it like rainfall after a drought. It does not solve every problem, but it refreshes the system, giving life a chance to stabilize. Lower rates create breathing room, and for farmers already stretched thin, that breathing room can be the difference between survival and collapse. Why refinancing makes sense. Rate cuts create a unique opportunity to look again at existing loans. Farmers with high interest debt can refinance, stretching out repayment terms or lowering monthly obligations. Restructuring may also free up cash for urgent investments like irrigation upgrades or livestock feed. It is not just about saving money today. Refinancing at a lower rate can smooth out the financial roller coaster, replacing unpredictable shocks with manageable, steady payments. In times of uncertainty, stability itself is worth as much as new revenue. The stubborn costs that remain. But here's the catch. Rate cuts may reduce the cost of borrowing, but they do not touch the biggest pressures squeezing farm wallets right now. Fertilizer prices remain high due to supply chain bottlenecks and global demand. Fuel costs rise and fall with geopolitical tensions. Feed prices track global grain markets more than domestic interest rates. These are the stubborn costs that no central bank decision can fix. They are tied to forces beyond national borders, forces that no single farmer can control. The relief of lower loans can feel small compared to the unrelenting tide of input inflation. Why lower rates do not always equal higher profits. Lower interest rates may sound like a win, but they can carry side effects. Cheaper borrowing may encourage more farms to take on debt, increasing competition for land and equipment. This can drive up prices, offsetting the benefits of lower rates. At the same time, rate cuts are often a response to weak economic growth. A slowing economy may reduce demand for agricultural exports, dampen commodity prices, and make it harder to sell crops at profitable margins. In this way, a rate cut is a double-edged sword. It eases pressure on existing debt but signals caution about the broader economic climate. Farmers must weigh both sides carefully. Smarter strategies for resilience. So what can farmers do in this moment? The answer lies not just in reacting to interest rates, but in building stronger financial foundations. Diversifying income streams is one option, whether through side ventures, renewable energy projects, or specialty crops that command premium prices. Creating detailed cash flow plans helps identify where refinancing or cost-cutting will make the biggest difference. Another strategy is building relationships with local cooperatives and credit unions. These institutions may offer tailored financing options, better terms, or flexible repayment schedules that large banks overlook. Trust, community, and collaboration often matter as much as raw numbers. Lessons from the past. History shows that rate cuts alone rarely determine the fate of farms. In the 1980s farm crisis, high interest rates crushed many operations, but survival often came down to who had diversified, who managed risk, and who had built resilient business models. Today's environment is different, but the lesson remains. Rates matter, but resilience comes from adaptability. Farmers who use this window of relief to strengthen their operations are more likely to withstand future storms. Whether they come from markets, weather politics, the bigger picture, agriculture does not exist in isolation. Every loan, every refinancing decision, and every budget choice connects to a global system of trade, energy, and finance. Rate cuts may feel like a temporary boost, but the long-term success of farming will depend on how well farmers can balance financial strategy with production strategy. In a world of constant volatility, the ability to manage debt wisely may become as important as knowing when to plant or harvest. The Fed may adjust the numbers, But the true power lies in how farmers use those adjustments to their advantage. Recap and reflection. We have seen how rate cuts reduce borrowing costs and create opportunities to refinance, why input prices remain stubbornly high, why lower rates do not always mean higher profits, and what smarter financial strategies can protect farmers in uncertain times. If you found this exploration insightful, remember to like this video, share it with others, and subscribe to Farmtips Diary. Do not forget to click the notification bell so you never miss a future deep dive.